History is littered with revolutions that get co-opted by the old guard. Think about it. Powerful technologies from printing press to the internet all started as these incredible decentralized forces for change. But what happened? Eventually they were consolidated by powerful centralized players, and well, today the world of cryptocurrency is probably standing in the same crossroads. The dream of a decentralized future is facing its biggest threat yet. And it's coming from the very institutions crypto was designed to overthrow. The epic battle between the decentralized crypto and banking giants like JP Morgan might already be over. For years, the crypto community has been dreaming for one thing: mass adoption. We imagine a future where big institutional money would pour in, legitimizing the space, and where tokenizing real-world assets would finally connect the blockchain to the global economy. Well, guess what? That moment is here. Giants like BlackRock and JP Morgan aren't just knocking on the door, they kick it down and are completely remodeling the house to their advantage. But is this really the victory we were hoping for? Or actually, is it a Trojan horse? The evidence is piling up that what we're seeing isn't the world financial system adopting crypto, but assimilating it. Today, we're going to break down how big banks led by JP Morgan are executing a quiet strategy to build their own blockchain-powered future, one that they have complete and total control over. It all started with the Bitcoin ETFs. The floodgate opened and institutional money rushed in, and also the market was never the same again. Then came the massive narrative: tokenization by BlackRock. The world's largest asset manager launched its BUIDL fund, the BlackRock USD Institutional Digital Liquid Fund, which tokenized US Treasury bills on the blockchain. Since it launched in March 2024, it has attracted billions in assets and has paid out over $100 million in dividends directly on-chain. This was hailed as a huge breakthrough. Finally, real-world yield on-chain, backed by the biggest name in finance. But if you look a little closer, you'll see BUIDL isn't some decentralized protocol. It's a permissioned, highly controlled financial product available only to qualified and approved investors. It gives you the efficiency of blockchain, but keeps you inside the walled garden of the traditional finance. This is the exact model the banks are now copying at a massive scale. So while the crypto world was celebrating these moves as a sign of acceptance by the banking system, the institutions saw something else entirely. They saw a technology that could make their existing systems faster, cheaper, and more efficient. They couldn't care less about the cypherpunk dream of decentralization. They're interested in using the blockchain to tighten their grip on the financial system. The institutional adoption we've been waiting for isn't actually a partnership. In my personal opinion, it's the beginning of a takeover. No one represented this strategic takeover more than JP Morgan CEO Jamie Dimon. For years, he was crypto's biggest public enemy, famously calling Bitcoin a fraud back in 2017, and more recently a pet rock. He even threatened to fire any trader at his bank for dealing in it. But while he was making headlines, his bank actually was quietly building. Fast forward to today, and Dimon's message had completely changed. In his April 2026 letter to shareholders, he identified blockchain, stablecoins, and tokenization as a whole new set of competitors that JP Morgan must aggressively confront to maintain its dominance in the financial market. His strategy is now crystal clear. Dimon separates the underlying technology, which he praises, from the public permissionless cryptocurrency like Bitcoin, which he still dismisses. He doesn't want to join the crypto revolution, he wants to build his own, better version of it, or at least in his opinion. And he's doing it with two key weapons, that is JPM Coin and a platform called Kinexys. JPM Coin is not a public stablecoin like USDC or Tether. It's a deposit token, a permissioned digital dollar that runs on a private blockchain, available to only JP Morgan's fully vetted institutional clients. It enables instant 24/7 global payments and settlements, all within JP Morgan's closed ecosystem. It delivers the speed of blockchain with the control of a traditional bank. This coin is actually powered by Kinexys, JP Morgan's rebranded blockchain division, formerly known as Onyx. Kinexys isn't just for payments, it's an entire ecosystem designed to tokenize real-world assets and execute complex financial contracts. This isn't some small experiment. JP Morgan's blockchain platforms are already processing billions of dollars in transactions daily. They even expanding their reach by integrating with institutional networks like the Canton Networks, which itself handles hundreds of billions in daily repo market transactions, embedding their technology deeper into the financial system's core. This is the construction of a parallel financial system, one that uses blockchain efficiency while throwing out the core principles of decentralization. Building better tech is only the half the battle. The other half is making sure your competition can't even get in the ring. And this is where the banks are playing chess while the crypto world probably is playing checkers. For the past couple of years, the banking lobby has been laser focused on one main objective, that is stopping crypto firms from offering yield on stablecoins. The American Bankers Association, or ABA for short, has made this its top policy priority for 2026 because they see interest-bearing stablecoins as an existential threat. Bank of America's CEO Brian Moynihan warned that up to $6 trillion in deposits could flee the traditional banking system for these higher-yield digital dollars, which would cripple the bank's ability to lend. They argued this would create a parallel banking system completely outside of their control and outside of the regulatory framework that the government have implemented. And their lobbying is working. Recent legislative proposals have included provisions heavily pushed by the banking lobby that would restrict or outright ban the offering of interest on stablecoins. While this bill aims to bring legitimacy to the space with rules on reserve and anti-money laundering, they also threaten to kneecap the ability of decentralized stablecoins to compete with traditional bank deposits. With this one move, the banks are using regulation to protect their turf. They're ensuring that when the world eventually moves to the digital dollar, the most attractive and functional version will be the ones they issue and control, like JPM Coin, which are safely integrated with the traditional banking system. They aren't just playing the game, they are rewriting and probably also writing new rules. What we're all witnessing is a classic historical pattern. The early internet was a decentralized utopia, a messy, creative, and chaotic space built on open protocols. But what happened over time? Well, powerful centralized programs like Google, Amazon, Meta, they didn't break the internet. They just built a more convenient user interface layer above it. And in the process, they captured almost all of the value. Blockchain is probably on the same exact path. The public permissionless world of Bitcoin and Ethereum was the chaotic, innovative first wave. But this next wave, probably it belongs to the institutions. They offer something the decentralized world still struggles with: trust, scalability, and a seamless user experience for their millions of existing customers. Let's just compare the two models. Decentralized crypto offer a permissionless public system, while JP Morgan and probably some other banks offers a private permission network where they decide who gets to play. Decentralized protocol want to offer yield and rewards, a key feature that the banks have successfully lobbied to ban for their competitors. And while crypto's biggest use case have been speculative, JP Morgan is using its blockchain for real-world profitable needs like 24/7 settlements, like tokenizing assets. In the end, The banks have the customers, the capital, and the regulatory power to build a more efficient walled garden version of a blockchain future. The dream of pure decentralization is a beautiful one, but it's also fighting against the powerful natural tide of centralization that has shaped every major technological revolution we've ever seen in human history. So, sadly, the evidence seems pretty clear. While the crypto community has been glued to the price charts and chasing the next 100x altcoin, the giant of traditional finance have been quietly building the infrastructure that will likely dominate the next century of finance. They are not adopting crypto. They are seizing its underlying technology to reinforce their own power. Through controlled platforms like Kinexys and JPM Coin, and through clever regulatory capture, they are making sure that in the new economical tokenization system, all roads lead back to them. So the question now for us is that no longer if institutions are coming, but what it meant now that they are here to stay. Is this institutional takeover just the price we have to pay for mass adoption? Or is the original cypherpunk dream of true decentralization now actually officially dead? Let me know what you think down in the comments below. And if you like this content, you might want to know that Iran and US ceasefire is a sham here, or Bitcoin is in danger from quantum computer here. So stay safe guys, stay curious, and I'll see you next time.